In this session, let's look more in terms of long-lived assets, which are nothing but non-current assets. Right, in the balance sheet, we had quite a few number of items that are going under the non-current assets. The major focus here is both tangible as well as intangible assets. We will not focus much in terms of investments and all, which are also non-current assets. The focus of this session is primarily on the tangible as well as non-tangible, intangible kind of assets. Tangibles are like your properties, plants, buildings, those kind of stuff. Intangibles are your softwares and copyrights and patents, goodwills. Those are the different kinds of. So only to that extent. But a company making investments in some other companies or something, that also goes as a part of non-current assets, but here we will not deal that particular aspect. Now, in this particular session, the major focus, or to start with, we need to understand the difference between what is capitalizing and what is expensing. Let's say we are spending something to buy a particular product. Let's say I have purchased a machine by spending some 50,000 bucks. Right now, if I show that 50,000, there are two ways of showing the 50,000. This is the essence of this chapter. Let's say I have spent, see, when I have spent 50,000 on the inventory, on the raw materials, we said it can be shown either as a part of cost of goods sold or it could be shown in the inventory. The same logic if I bring in for this chapter, what we are saying is whatever the amount I am spending on a product, like let's say a machine, right, not on the raw materials. The only difference between the two sessions is there we are talking about raw materials or semi-finished good which actually goes into the product which is getting sold. I mean, I'm not talking anything about in terms of current assets or something. A product which is going a spare part or something that is going into the item that will be sold. Whereas on the other side, let's say I'm talking about a machine. Machine is used to produce the item, but it is not getting sold. It's not the product of the company. Wherever some item is the, see, let's say I'm talking about a bike manufacturing company. The major thing which the company sells is bikes. And whatever the items that go into the bike, maybe tires, maybe spare parts, maybe engine, whatever they are all, we are treating them as inventories. Whereas probably a bike, a plant required to manufacture more bikes, or a machine which can do a automatic fitting of something, right? We are not selling those items. We are using them to produce our product. So those kind are probably some supporting things. Let's say I am purchasing AC for some reason, but my intention is not to sell the AC or something. I am using it as a part of a production of my product. So all those things, whatever I am spending on them, there are two ways of showing them in the financial statements. One is I can show them in the balance sheet as assets. The other is I can show them in the P&L or income statement as an expense. I have spent on it, right? I can show it as an asset in the balance sheet, or I can show it as an expense in the P&L statement, right? Now, when I show it as an asset, we call it as capitalizing. When I show it as an expense, we call it as expensing. And the basic scenario in case of capitalizing is, if at all I have a feeling, if I am reasonably convinced that particular product will be used for more than 1 year or beyond the current financial year, right? That particular product will be used beyond the current financial year, we can capitalize it. But if it is used everything within the same financial year, whatever I have spent, after the end of this financial year, it has I will not use it at all. Let's say though I have spent 50,000 bucks on a computer, if I'm going to use the computer for next 3 years, I may capitalize it. But if I'm sure that I will scrap the computer after 1 year, then I have to treat it as expense in the income statement itself. That's a clear cut difference. But there are some rules coming up regarding them. But on a simple definition kind of a basis, this is what is the definition between capitalizing versus expensing. So when you are doing capitalizing, obviously your assets are higher because you are treating that cost as an asset. So your assets are higher. Assets are higher means liabilities side also something should be higher, which means equity will not increase the liabilities because we are not borrowing anything, right? And why the equity is higher? Because we are not treating that as an expense. We are not treating it as an expense means your net income is higher, profit after tax will go up, which means here the retained earning, profit after tax is again linked to retained earnings. Retained earnings is going up. Retained earnings is as a part of the owner's equity, shareholders equity. So that is going up. So when the assets are going up, something should be balanced either in liabilities or in owner's equity part. Actually, owner's equity is going up, liabilities will not go up. Owner's equity will go up because it will not be treated as an expense, which will result in profits going up, and that increased profit will get translated into increased retained earnings, right? So because of, and even the cash flow from operations will go up here. Why? If I am capitalizing it, non-current asset, difference in the non-current assets go into cash flow from investments. If you remember, where does all current assets and current liabilities go into cash flow from operations. Non-current assets, they go into cash flow from investments. Non-current liabilities go into cash flow from financing, right? Now that this becomes a non-current asset, it goes as a cash flow from investment, whereas if I had treated it as an expense, P&L statement, it would go as cash flow from operations. And the other day we have seen in the cash flow statement, cash flow from operations is one of the strongest things which every company will look at, because only from there they are computing the free cash flow to the firm. FCFF and FCFE are computed purely from cash flow from operations, not the total cash flow statement, right? And we have also said that free cash flow is one of the powerful mechanisms for doing the valuations of the firm today, right? So if the cash flow from operations is higher, there is a good chance that the company will be valued at a higher price, right? So even from that standpoint, capitalizing your assets will help you out. And one more thing that comes out is, because you have capitalized the asset, the expense is lesser. The expense is lesser means the net profit or the net income will increase in the first year. But that asset has to be depreciated over the next few years, right? Everything whichever you are treating as an asset, there is a depreciation to it. If depreciation means additional expense from the year 2 onwards, which means from year 2 onwards, your profits are going to go down. But in year 1, when you have actually purchased that asset, purchased that product, your profits are going to be much higher. The reason being, simply look at it like this. Let's say my revenues are 100,000 in both the years, this year and next year. Only 2 years I am talking of. 100,000 in both the years. Let's say I have purchased a product worth 50,000 bucks. If I am expensing it, the whole 50,000 comes here itself. And here it is 0, the cost, the expense. So overall, the profit wise, I'll get 50,000 here, whereas here it is 100,000. Correct? Now, when I am capitalizing it, what it says is this 50,000 will go into the assets. If 50,000 goes into the asset, that asset has to be depreciated. So, because we think that it has a 2 years life, what we'll do is we'll put 25,000 as the cost for 2 years. Instead of putting 50,000 as the cost for 1 year, 25,000 will become the cost for 2 years. This is what is the depreciation part. So actually what is happening, your profit in the first year is becoming 75,000, because you're, instead of 50,000 as expense, you are putting only 25,000 as the expense. And in the second year also, your profit is going to the extent of 75,000. So that is what we are saying. In the first year, your profits are higher, whereas from the subsequent years, your profits will go down. So companies, for short-term purpose, to show very high profits in probably in a year, if they are not doing much better, if their profits are much lesser, to show a higher profit in a particular year, they may resort to this kind of a manipulation. They may treat a particular purchase cost as a capitalization, though everything has to be expensed in this year itself. Right? Okay. Now, there is some benefits. Of course, some of them can definitely be capitalized. There are some benefits associated with the capitalization, as we have seen, because from company's standpoint, they can very well show higher profits because of capitalization, which probably and even the cash flow from operations will go up, which means there is a possibility that the financial analyst will value the firm at a higher price. Right? Then, one more aspect in the same context is interest during the construction period. Let's say we are talking about a long-term capital project, a big real estate construction project, right? Those kind of projects typically incur a very heavy borrowings also, which means there is a huge, let's say some company has borrowed 2,000 crores for building, let's say, an airport, right? An airport is getting developed with 2,000 crores. That, let's assume that 2,000 crores is taken in the form of a loan. Even if I go for 10% interest, 200 crores is the interest per year. But typically, the airport, to become operational and get first revenue, it will take at least 5-6 years. Right? Let's say to just become operational, it will take 5-6 years. And we have said the revenue recognition, probably for those kind of projects, I may do it on a percentage of completion kind of a basis, or those kind of stuff we can very well do. But whatever the interest that has come on the borrowings during that period, what it is saying is, even you borrow for the interest also. You borrow because you don't have any money, right? Right? Your first revenue will come only after 5 years. Right? But the bank will not wait for 5 years for the payment of interest. So what the mechanism is saying is, whatever the interest part you have to pay, let's say 200 crores for the next 5 years. So which means as a part of your borrowing, add up another 1,000 crores. Don't borrow 2,000 crores, borrow 3,000 crores. So that 1,000 crores you can pay as an interest. So you adjust the things in such a way that whatever is the interest for this accumulation period where you don't get any revenues, even treat that as an extra cost, extra investment from your side, and treat that also as an asset and depreciate it from the year when your revenues are started flowing. Treat it as an expense, not from year 1, but treat it as an expense from year 6 where you are actually getting your revenues. That is what we are calling as capitalization. So even it is, so generally what, see, when I spend something on it, I can decide whether to capitalize it or expense it. Assume now I am paying the interest to the bank. That interest payment is also like a spending, right? Now I can decide whether I should capitalize it or expense it. And in general, whether it is GAAP or IFRS, both of them allow that whatever the interest you are paying during the construction period, you can treat it like an investment. Probably a simple way to present it is, whatever the interest you are paying to the bank during the period where you are not getting your revenues, which is like a during the construction period itself, before the usage starts, where whatever the interest you are paying to the bank, you can treat it as an investment itself, extra investment, and treat it like an asset. Right? Just like you have bought a machine, you say you have given something to the bank. Though you have given an interest on your loan only, because your loan did not materialize in terms of business still, what we are saying is whatever the interest you are paying during the construction period, you can capitalize it, treat it as an asset. You don't need to treat it as an interest in the income statement until that year, until the year you get your revenues. And because of this, then assets are going up, because even the interest which you are paying, you are treating it as an asset. The assets are going up, so all these rules will get applicable again. And the interest coverage ratio will be higher, because what is the interest coverage ratio? EBIT by I. Now I is lesser because you are not showing interest in the income statement now. Even that interest, whatever you are spending, you have capitalized it. So interest which you are showing here is much lesser. So your interest coverage ratio will typically go up. So from an analyst standpoint, again, apple to apple comparison is very much required here, because there could be some company which might have capitalized the interest, whereas there could be some other company which has expensed the interest, because it's only a flexibility. If the company wants, it can capitalize it. Now, when you are comparing two different financial statements, it may so happen that one company has capitalized, or probably three companies. One company has capitalized the interest. The second company has expensed the complete interest. The third company did not even borrow everything, it has used its own, where the interest is nowhere applicable for them. Right? It has used only the equity capital. Now, to bring out the comparison comfortably between the three companies, the suggested point is everything make it as expensed. Even if the company has capitalized it, identify how much has been capitalized, treat that as an expense for your valuation purposes. Because analyst's financial statement need not match GAAP, need not match IFRS, it has to match his own satisfactions. The financial statement which any financial analyst prepares, no matching with GAAP, no matching with IFRS, it has to match his own satisfaction. So, and it has to be a realistic reflection. So from that standpoint, if two companies are following two different kinds of capitalization modes, one capitalizing, the other expensing, the suggestion is to the extent whatever they have capitalized, remove it from the assets, right? Because we always go from a reality standpoint. Remove it from the asset, treat it as a part of expenses, and then do the comparison. Then when it comes to intangible assets, there are three major categories in intangible assets. Three major categories in the intangible assets. One is the intangible assets which you have purchased and which have a finite life. Only 5 years, 10 years, they have a defined life period, and you have purchased those intangibles by paying something, probably like patent. You'll purchase a patent, you'll take a patent by paying some amount, and that patent's life period could be 3 years or 5 years or something like that. Or same thing will happen with the copyright. You have to pay something for getting the copyright, and there is an applicable period for that. So wherever you are purchasing means you paid for it, right? You paid for getting those. Intangible is because you are not able to touch it. It's probably a software. You have purchased a software license, which could be for 3 years or 5 years or 2 years, whatever it is, right? So all these things, we call them as purchased finite life intangible assets. You just do an amortization over the life of that asset. If the copyright is taken for 50,000 bucks for 5 years, so 50,000 treat it as an asset, and in the expense which is under amortization, put 10,000 per year for 5 years, right? That is what you do for purchased finite life intangible assets. Now if there are intangibles with lifetime, like goodwill, there are brand values, there is nothing called this is applicable only for this much period. Or in some cases, let's say if copyright is given forever, lifelong copyright, right? Probably on this book or something, I have a copyright for life. If I have something like that, if I take a lifelong copyright, I don't need to do any kind of amortizations on that. Only if the life is finite, I have to do an amortization. Any intangible, let's say I have purchased the software and I can use it forever, right? No restrictions, anything, I can use it forever. Then what we are saying is, I won't amortize it. But if I feel no, after 2 years or 3 years is of no use at all, probably I have to replace it, then I will start doing the amortization for that over a 3-year period. So whichever are those intangibles which are not amortized, we are saying they have to be tested for impairment on an annual basis. Okay, did the goodwill go down by any cause? There are different values, there are different mechanisms of intangibles valuation, right? So you may have to use one of those which is right now for us out of scope, but using the various mechanisms for intangibles valuation on an yearly basis, you may have to check out whether the goodwill has gone down or is it still maintained. So that is what we are calling as test for impairment on an annual basis. Now the third kind of intangible asset is what you have internally developed, right? Like some kind of software you have developed internally, right? Some kind of expertise you have developed internally, some kind of process you have developed internally, which will definitely help the company in the longer run. But the mechanism says anything, any intangible which is developed internally, you treat it as an expense itself. No capitalizing for that particular stuff. Only if you have purchased an intangible, that too if it has a finite life, then only you are treating it, or even infinite life also, you are treating it as an asset. You can capitalize it, but you will do the amortization only for those assets which have a finite life, and you will not do any amortization for infinite life kind of assets, right? And there is a special mention of R&D expenses. Whatever the company, especially pharma kind of companies or some specific industries, they spend very heavily on R&D, right? In that also there is a difference between GAAP and IFRS. What the GAAP says is both R and D. Whatever are the expenses that you are incurring on research part as well as the development part, though it may give you a benefit for 5 years or whatever, treat everything as an expense for this year itself. No capitalization of R&D. Whereas at least IFRS, what it has said is the development part you can at least capitalize it, but the research part, whatever you have spent on research for this year, you have to treat it as expense in this year itself. But whatever has been spent on the development, you identify how much is associated with the development part, and that development part you treat it as an asset. You capitalize it over a 2-year, 3-year, 5-year, whatever is the period you think will be the applicability of that particular development, right? Then this part we have seen earlier also, the various types of depreciation that are typically there. Straight line depreciation. Okay, I'll take one example which will do the entire all three types of depreciation. Let's say I have purchased an asset for 100,000 bucks, right? I've purchased something for 100,000. I am expecting that its life is 3 years for simplicity purpose, and probably it has a salvage value of 10,000. Means after 3 years I should be able to dispose it off at 10,000 bucks, right? So what happens is, in the initial year, for all the three, at the time of purchase, my asset will be 100,000. Once I purchase it, my asset will be 100,000. There are three mechanisms which we will talk about here: a straight line depreciation method, accelerated, which is actually called as double declining balance method, or we also will talk about what is called as the units of production kind of a method, right? What we are saying is, if at all I am talking about straight line depreciation, we are spreading the depreciation uniformly over the period, right? So because I have purchased the asset at 100,000 and I may sell it today, only I am thinking that I may sell it at 10,000. Reasonably I am thinking that I may sell it at 10,000. So what we will do in straight line method is, we'll take the difference of these two. The 90,000 I will spread over the 3-year period. So the expense will become 30,000, 30,000 and 30,000. This is what is the straight line depreciation. So what will be the asset value? At the end of first year it will be 70,000, because 30,000 is the usage for this year. At the end of the second year it will be 40. At the end of third year it will be 10. And that is what is the scrap value. That is how it goes as a part of your straight line depreciation method. Fine. Now when you are going with let's say the accelerated method or double declining balance method, the way it works out is, okay, you won't consider this part at all in the double declining balance method, right? Initially this will not be considered at all. Only your purchase price will be considered, right? And we are saying 3 years is the useful life. So what I will do is, I will start with this kind of a formula: 2 by useful life. 2 by useful life. Useful life is 3 years. 2 by useful life into the cost of the asset, which means almost 66,700 is what is going as a depreciation in the first period itself, right? Then what I will do in this case, I will take the balance in the value of the asset. After 66,000 is depreciated, 33,300 is the balance of the asset. For the second year, what I'll do is, I'll do it as into 2 by 3 again. Only the 2 by 3 is applicable, which is 2 by the useful life of the asset. That is the multiplication factor every time. But that is applicable only on the balance in a double declining kind of a method. Okay, 2/3 of 33,300 will become 22,200. So probably what is still left is 11,100. Again, if I want, I can continue the same process. On 11,100, I can take 2/3. But sometimes what the companies do is, after a few years, where the number has gone very small, they'll say, we'll whatever is pending, we'll depreciate it in this year or equally spread in the next 2 years. Which means that they will slowly move to a straight line kind of a method, because in double declining there is no ending. Even for 100 years also you can depreciate that. Every year the value could be 1 or 0.5, 0.005. It will never become 0. Only 2/3 of the original it becomes. It can never become 0. So that's where what the companies do is, after a certain point in time, probably once the number has come much smaller or much lesser than the straight line value, what they'll say is, we will either convert it in the next 2 years, we'll allocate the remaining amount, or probably in this case, because there is a salvage value, they will take only to the extent of 1,100, because 10,000 is the salvage value that is there. That salvage value is considered towards the last, not in the beginning here, right? In case of straight line method, the salvage value is taken in the beginning itself, and then the depreciation comes. Whereas in case of the accelerated or double declining balance kind of methods, the salvage value is considered towards the last, not in the beginning, right? Your final adjustment is what will happen, because only 11,100 is left, but out of that 10,000 is going, is the salvage value. So the last year probably you take the depreciation only to the extent of 1,100. That's a accelerated depreciation kind of method. And the units of production method, which is the third one, is purely based on usage, not on time. Let's say this is the same asset, 3 years useful life, everything, let's say it's the same, but the only difference I will bring in is, probably, I'll use, let's say that's a bike, and literally, let's say I know that bike will give some 100,000 kilometers. 1 lakh kilometers is what it has the capacity of. Its strength typically is 1 lakh kilometers, right? Now I am assuming that I'll use 50% of it in the first year, probably 30% in the second, and some 20% in the third. Usage wise, I will forecast. Will I use it equally over a 3-year period, or probably in the first year I'll use more and slowly, slightly lesser in the second? And for that I will identify on what basis I will define the usage. In the bike I am saying the kilometers, right? Probably okay, it will give me a maximum of 1 lakh kilometers, and I'll assume that I'll use it 50% of the usage in the first year itself. Almost 50,000 kilometers I will drive in the first year, then 30, then 20 kind of stuff. Then what the mechanism says is, even the depreciation you allocate in this mechanism, not 1/3, 1/3, 1/3. You allocate it as 50/30. So take 90,000, which is post salvage value, break it into 50/30/20. So which means in the first year, actually 45,000 is the depreciation, 50% of 90,000. 30% of 90,000, which is 27,000, is in the depreciation in the second year, and 18,000 is the depreciation in the third year. This is what is the units of production or units of usage kind of a method. So these are the three most commonly prevalent methods that are there, where the first and the third, the straight line as well as units of production, they will consider the salvage value in the beginning itself, remove the salvage value, and the remaining amount is distributed over the years. Whereas when we are going ahead with the accelerated, which is a double declining balance method, initially we don't consider, when we are computing the first depreciation, we don't consider the salvage value. We take it on the final itself, but finally we will adjust it with the salvage value. Right? So these are the three methods, and these three methods are applicable even to amortization also. No difference. Right? In the amortization also for the intangible, because depreciation for tangibles is same as amortization for intangibles. So even in case of intangibles, you can use any of the three methods. Right? Though generally people use a straight line, even for depreciation, in most of the cases you see straight line methods only, but you can very well use the remaining two kind of methods also, both for depreciation as well as amortization. Now let's look at some of the analytical aspects here. If the depreciation expense is high, what could happen? Expense is higher, so profit will come down, because depreciation is what is an expense in the income statement. So your profit, net income will come down. Net income is coming down means return on assets will come down, because return on assets, the numerator is the net income itself. So all return on assets, return on equity, they all will come down. These kind of relationships, if something happens, should be the pure focus, primary focus for you in this entire FRA. The prime focus for you from answering standpoint is, what could be the impact of capitalizing versus expensing, or what could be the impact of using one method of depreciation versus the other method. This kind of logical frameworks is what you have to be more comfortable with. And because it's a depreciation, which is a non-cash movement, cash flow statement is not affected at all, unless there are some differences with respect to taxes, because your net income will change. Right? Because of that, the taxes, the profit before tax could change based on the expense. Because of that, there could be small tax differences. If you don't consider the tax part of it, there is no impact on the cash flow statement at all. Right? And sometimes what the companies do is, if at all they want to show high profit, they have to reduce the depreciation. If they reduce the depreciation, the net income will go up. So what they do is, suddenly they will increase the number of years, the useful life of it, right? Or they will increase the salvage value. One of the two or both. Even if the salvage value is increased, though the number of years are same, let's say the 100,000 piece, right? If I am saying salvage value is 40,000, not 10,000 after 3 years, my depreciation is suddenly coming to 20,000 per year. Instead of 30,000 per year, it has come to 20,000 per year. So through that mechanism also, the depreciation can be reduced and the profit of the company can be increased. Similarly, no, it's not this asset will give me 10-year life, not 3 years life. In that case also, the depreciation amount will come down. So because of that only, every accounting standard comes up with some kind of suggestions also on the minimum depreciation amount that has to be done for each of the assets. Right? Probably they'll say, okay, for a kind of a motor vehicle, at least 10% should be depreciated every year, assuming 10 years is the life. Now, you cannot take it to 20 years life at all. Probably if you want to make it 5 years life, you are free to do it. But you cannot extend a bit beyond 10 years life. So they define some kind of standards in terms of what should be the minimum depreciation amount for these kind of scenarios. And there is also IFRS has actually come out with the scenario of component depreciation. What it means is, let's say we are talking about a big house, right? The house, let's say, which is worth, which you have purchased it for 50 lakhs. You have purchased the house for 50 lakhs, some for business purpose, whatever it is. And let's assume that you have estimated that 25 years is the life of that building, right? So as a part of the depreciation, you can put 2 lakhs every year. For 25 years, you can put depreciation as 2 lakhs, assuming 0 is the salvage value and you are following a straight line depreciation kind of a method. You can very well put 2 lakhs for each. Now let's say within this house, you have furnishings. This 50 lakhs came along with the furnishing, right? Or whatever, some big component which is a significant component. So probably this furnishing, out of this 50 lakhs, let's assume 5 lakhs is the worth of this furnishing, furniture or whatever you call that, right? And I am saying this furnishing has a life of, let's say, only 5 years or 10 years. Every 10 years you have to replace it, right? Every 10 years you have to replace it. Now what the component depreciation method says is, if you are not using component depreciation, the entire 50 lakhs you will depreciate it with respect to 25 years. Now what you will say is, in the component depreciation, you will treat this 5 lakhs separately and this 45 lakhs separately. Getting it? So this 45 lakhs piece, you will depreciate it for 25 years. Whereas this 5, so for this year, the actual depreciation that comes out is 45 by 25, let's say 1.8 lakhs. Whereas corresponding to this 5 lakhs, you will get 0.5 lakhs because it's only a 10-year. That furnishing is only a 10-year life. As a part of component depreciation, you are treating each one as a separate component and you are doing a depreciation separately. So it actually comes out to 2.3 lakhs. Whereas here you are showing only 2 lakhs. After 10 years, so you are spending another 5 lakhs because you have to, I mean, depending on whatever is the cost, assuming that the costs are same, what will happen here, you will keep showing it as 2 lakhs for all up to at least 10 years. I mean, for 25 years it continues like this, but after 10 years you are repurchasing it. You are repurchasing the furnishing. Assume that you are repurchasing the furnishing for another 5 lakhs. I am not changing the numbers at all. Assume that you are repurchasing the furnishings at 5 lakhs. Now that extra 5 also has to be depreciated. So from the 11th year onwards, that 5 will be depreciated for 25 years, which means from the 11th year onwards, another 0.2 will be added here. See, forget about when it is used. See, right now everything is 50. I will look at it purely from a building standpoint, right? Everything is looked at from a building standpoint. Okay, the simple logic is, okay, 50 lakhs is the current worth of the building, right? So assume that even the furnishing comes for all 25 years, I'll depreciate it. So as of now, 2 lakhs for all 25 years. right? Now, after 10 years, that furnishing goes completely awkward. After 10 years, the furnishing becomes completely useless and I have to replace it with a new furnishing. Now, that extra 5 lakhs is what I will be incurring, right? Extra 5 lakhs is what I will be incurring. So, that 5 lakhs also I will add up to the cost of the building. So, the building has a 25 years life, not from that point in time. The total time for the building, because the furnishing I may take it into some other building also. So what I am doing there, that 5 lakhs whatever I am spending, another 0.2 is what I will allocate for the remaining 15 years. Right? So it is becoming 0.2 for the remaining whole period. Then the same logic, sorry, the 5 lakhs is spread over a 15-year period, not over the 25 years. The 5 lakh whatever I am spending there is spent over the remaining 15-year period. So what are the numbers that are becoming 2, 2, 2 up to 10 years 2, even let's say up to 20 years 2. First thing, up to 25 years it is going like this. But in the 11th year, because I am spending something more, the 5 lakhs, the 5 lakhs I will spread over a 15-year period. So probably another 0.3 lakhs or whatever that gets allocated up to here. Now after 5 more years, after 10 more years, I will again replace the furnishing. So only 5 more years for the building, but still I spend, let's say, 5 lakhs. So probably 1 lakh is what is coming here. So my depreciation will keep increasing over the period if I am not following a component depreciation. Right? So because of that, what happens in the initial years, my profit looks much higher. Right? Whereas if I am following a component depreciation, my depreciation is slightly uniform over the period. Right? Because I'm separating these two, I'm computing the depreciation for both the items separately, not as an integrated unit. The reality of the otherwise, even the furnishing initially, at least for 10 years, it is treated as if it's a part of the building. Getting it? See, in that example, when I don't take components separately, I'm not treating furnishing separately at all. Furnishing means it's a portion of the building. Building has another 15 years of life. So whatever I am spending on furnishing, it is treated as if I have done some kind of an improvement to the building. It's not treated as if I have purchased a furnishing there. It's treated as if I have done an improvement, modification to the building, which will be spread again over the life of the building. Getting it? So whereas when you are doing component depreciation, you are treating each component separately. Right? Whether the building is existing or not existing, this furnishing can be carried to somewhere else. All these things can very much happen. So treat the building separately, because building has a 25-year life, but probably the furniture and all hardly has a 5 to 10 years life. Treat them separately for the depreciation purpose. So whatever is the house which does not include the furnishings, whatever is the cost of it, right? Probably in the house, the rooms may come for 25 years. But whatever is the costly, what you call the painting or whatever you have done, a big painting cost you have incurred on the building, you may have to change it for every 5 years. But initially the painting was included as a part of building cost itself. Now what the component depreciation is saying is, because these two are not for the same period, treat painting costs separately, depreciate it for those many years. Treat non-painting building costs separately, treat it for those many years as a part of your allocation. That is what we are calling as a component depreciation. Right? Yeah. The next thing which we are talking about is the amortization methods. It's the same as depreciation. But the only thing is you have to look at the useful life, because see, for some of the let's say for a machine or a vehicle, for tangible assets, what you see is the useful life can be determined. I mean, based on experience, we may come out with the useful life in some of the cases, or probably for a vehicle. Typically, there is an established standard saying 10% you depreciate every year, something like that. For a building, come 30 years. Whereas when it comes to intangible asset, patent, I may take for 1 year, someone on some of them I may get for 2 years, some of them I may get for 5 years. There is no specific definition. It may be guided by legal or contractual or some kind of obligations that are coming in. So you have to be careful in terms of choosing what percentage or what number you have to use for each of the periods. Now, there are four major aspects which we are considering in this context. One being the revaluations, right? What if the asset has to be revalued? What if the asset is impaired? What if the asset is derecognized? These are the three major areas, and within that itself we have if it is sold or exchanged kind of stuff. So now we are talking about revaluation. Every company, if it is following IFRS, it can follow a revaluation based model, which means on an annual basis, every asset that it has, it can get them revalued to the market value, right? Even though it is not selling them off, it can get them revalued to the market value. So when it is getting revalued to the market value, that value can be either higher than what is shown in their books, than what is the historical cost. The market value, which is a revalued value, can be higher or lower. Now, that excess, so that higher or lower, they will represent it as the asset. First thing is, the revalued value can be treated as the new asset value, right? Not the historical cost, whereas the new revalued value can be treated as the asset. Now, how do you treat that excess? Now, let's say initially as per the, okay, I have purchased the asset at 100,000, 4 years depreciation. So, after first year, the depreciation is 25,000 and the value of the asset is, let's say, 75,000. Fine. Now, here I am getting the asset revalue. If I am getting this particular asset revalued, it may either become 80,000. Let's say the market value, it may be either 80,000 or 70,000. What the IFRS model says is, you put it as 80,000 or 70,000 in the asset, not 75,000. You write it as 80 or 70, whichever is the value. If that's the case, how do I balance it with the liabilities part? Right? Asset, I have increased it by 5,000 or decreased it by 5,000. So how do I match it? What it says is, if it is decreased, this 5,000, book it as a loss in the income statement. Loss means additional you are losing out something, means your profit will come down, right? If it is an additional expense, your profit will come down, immediately your retained earnings will come down. So it is balancing off with the fall in the assets. The retained earnings are also falling, both are getting balanced out. The second scenario is, what if it is a gain? What if it becomes 8,000? 5,000, you should not show it as a gain, because the accounting standards always believe in conservatism. So this 5,000, you should not show it as a gain, but still you have to balance it. For that only, we had that other comprehensive income in the balance sheet. In the other comprehensive income, you show that 5,000. So though the asset has gone up by 5,000, your equity is also going up by 5,000 through that component called other comprehensive income. That is your first transaction. Depending on whether it's a loss or a gain. If it is a loss, you are taking it into the income statement directly. If it is a gain, that excess you are not taking, it will bypass the income statement. It will get reflected only in the equity portion of the balance sheet, the first part. Now, in the second part, let's say in the next years, if there is a loss, I mean, let's say you have booked, initially you have booked it as a loss. Next year, you can recover up to the loss which you have booked. You can treat it as a gain. Up to the extent of 5,000, next year, you can show it as a gain in the income statement. But if your gain is 8,000 next year, like let's say next year as per the books, let's say this should be 50, another 25,000 depreciation. Let's say it should be 50,000 or something. But when you got it revalued, let's say it was 60,000. Right? You got it revalued, it became 60,000. Because you have booked, so your asset will be showing 60 only. But this difference is 10. Right? Now the difference is 10. If the difference is 10, what it says is out of this 10, 5 you can show it as a gain in the income statement because you have booked it as a loss earlier. Up to 5 you show it as a gain in the income statement. The remaining 5 show it in the other comprehensive income. So that's how the adjustments happen, whether it is a gain or a loss. To the extent of loss which you have booked, you show it as a gain in the income statement. Anything excess beyond that, you have to take it into the other comprehensive income in the balance sheet itself. Whereas in case of US GAAP, the formula is very simple. No upside. Downside only you have to look at it, no upside. So which means no upside revaluation at all. And downside, there is another name for it called impairment. The asset value going down. So that's where we say no revaluation model at all. In case of, if it is a loss, that from 75, if it is 80, US GAAP says show it 75 only. And don't talk about 80, don't think about 80 at all. That is the US GAAP model. Whereas if it has gone to 70, it says, okay, 70 only you show as asset, 5,000 you show as loss, but don't try to revert back that 5,000. It's 5,000 loss, that's it. That is the US GAAP kind of a model. No subsequent years writing it back. Now impairment we have just now seen now. The same logic in case of impairment, right? Carrying value is nothing but the book value. The book value is 75,000 here in the earlier example. After you remove, whenever we use the word called carrying value, it is nothing but the book value. Right? These two are again interchangeably used kind of term. A carrying value versus a book value. Now, as per the books, it should be 75,000. Correct? As per your books, it should be 75,000. Whereas the recoverable amount is the amount which you can actually get it, market value. If you really want to sell off that asset today, just like inventories, if you really want to sell off that asset today, which is again the fair value minus the selling cost of sale. If you really want to sell off that asset today, let's say it's going to give you only 70,000. If you want to use it, it is 75,000. If you want to sell it off, let's say it is 70,000. That is where we are saying my asset is impaired. So the 5,000, I will book it as a loss. Right? My book value should be 75. Whereas when I get it revalued in the market and see that the recoverable amount for it, if it is only 70,000, what we are saying is show the asset as 70 only, but book it as 5,000 as the loss. And as per IFRS, you can do the upside part of it to the extent of 5,000, whereas as per GAAP, no recovery. But Couple of small differences here in the way you are defining the recoverable amount. What it says is compare whatever is this is the net realizable value which we have used even in case of inventories. Compare the net realizable value versus, see, either I can dispose that machine off or I can use it. See, let's say I have a machine, right? As per the depreciation I have done, let's say 75,000 is still pending for it. Based on my depreciation model, 75,000 is pending for it. Now there are two things which I have to check for the whether it is really impaired or not. Compare two things. One, if you dispose it off now, how much you will get? If you dispose it off right now, how much you will get? Price minus your cost of sales. Two, if you use this machine for some more years, how much you may get? Use this means probably it may produce another 20 more bikes, or it may produce 100 more bikes, and on each bike are probably over the next 3 years. So these are the profits I may be getting in the next 3 years because of using this machine, and these are the present value of the profits that I will get by using this machine. That is what we call as the value of the usage. Whatever is greater of these two, I'll compare it with the carrying value. If the carrying value is more than both of them, I will definitely treat it as impairment, and the difference is what? I'll book it as a loss. Whereas in case of US GAAP, that loss cannot be reversed at all. So because of that impairment, anywhere you find impairment, you will see a loss mentioned in the income statement. And because of the loss that is mentioned in the income statement, your profits will come down. Whereas in case of cash flows, nothing is impacted because it's just an allocation difference. There is nothing which is really you are getting. Unless you sell off that asset, there is nothing which you are going to get on that. So it's just a notional kind of a change. So no impact on the cash flow statement at all. Right? Yeah. The third scenario which can very well come out is derecognition of the asset. Probably the company, see, let's say after using it for 1 year, I may sell off the machine, or I may abandon the machine altogether, right? Probably I may treat it as a scrap after 1 year itself. It is not giving me the required benefit, so I'll scrap it off. That is what we call as abandonment. Or I may exchange it for a better asset. All three are possible. In those three cases, we are calling it as derecognition. When I am selling off the asset, I know what is the book value till today. 75,000 is my book value. So if I have sold it for 80,000, 5,000 will be treated as a gain in the income statement, because once we sell it, the gain and loss directly goes into the income statement. That gain is always compared not with the purchase cost, but with the book value. Post depreciations, whatever is the cost that is there, the comparison happens with that kind of a number. So whatever is the sales proceeds minus the book value, whatever I am getting, if it is a gain, I will show it as a gain in the income statement in the other income category. If it is a loss, I will show it as a loss in the income statement. Straightforward. But if I have abandoned it, think of it as if you have sold it for zero. That is what is the meaning of abandonment. So if the book value is 75,000, right? If you are abandoning it, it's as good as you have sold it for zero. So 75,000 is your loss. That entire 75,000 you will book it as a loss in your income statement. But if you have exchanged it, this is a slightly tricky thing. Let's say the 75,000 piece, right? That particular machine is having a book value of 75,000. Correct? Now you have exchanged it for a new product and paid 2 lakhs for it. For an improvised machine, you have paid 2 lakhs for it on an exchange offer. Now, what it says is, find out to represent what is the gain or loss. Find out, okay, what is the real what is the real worth of this old machine in the market. Assume 80,000 is the worth of that machine, right? So this guy has offered it to you, a new machine, at 2 lakhs after taking 80. Assume that he has taken out 80,000 for that machine. He has offered it at 2 lakhs 80,000. I mean, the actual price of it, as per your understanding, it should be 2 lakhs 80,000. After which probably he has taken out 80,000 for your old machine and he has sold it to you at 2 lakhs. Now what you will see, what is the actual worth of the machine in the market? See, this 80,000 is as per your valuation, not as per. See, we are exchanging one product. We are exchanging one TV for a new TV. Right? So, we think, okay, this TV should give me, let's say, 2,000 at least. Or 5,000 at least. Right? I used it for so many years. Now, if I dispose of the TV, it should give me 5,000. Now, you are going to a shop under an exchange offer scheme and he says the new TV along with purchasing the old TV, right? He will say, let's say the cost is 40,000. You pay 40,000 and give your old TV. I'll give you a new TV. So now according to you, how the calculation will go? Okay, my TV is worth 5,000, right? So logically speaking, if he is selling this piece for 40, it should be 45,000 in the market. If it is for 45,000, he taking it, you don't know at what price he is taking it. You are assessing that he should take it at 5,000, right? So any TV which is worth 45,000, if he is giving you for 40, you feel that you got whatever you got. But let's say if the price of this is 46,000 in the market, it means then you have got a gain of 1,000. As per your books, you should get 5,000 on the old TV. 5,000 on the old TV, 46,000 is the price of the new TV in the market. As per you, you should get only, you should get the new TV at 40,000. But the shopkeeper has sold you at 40,000, not 41,000. As per your calculation, the new TV, which is 46,000 in the market, should be sold to you at 41,000. Correct? Whereas the shopkeeper has sold it to you at 40,000, which means 1,000 is the real gain. That is the gain you book when you are doing an exchange of the asset. Now let's say the actual price in the market is only 42,000, right? 42,000, and he is selling it to you at 40,000. So as per you, you should buy it at 37,000. Assuming 5,000 is your book value, you should buy it at 37,000. But you are buying it at 40,000. So 3,000 is the additional expense for you. You book it as a loss. Especially with respect to the exchanging of the assets. This is the way we compute the value. Then in any kind of asset scenario, these are some of the disclosures we will see in the footnotes. For our, as a part of the footnotes, you will see the carrying value for each class of asset, which means probably buildings. What is the book value? Plant, machines, vehicles, computers, right? Patents, software. For each of the categories, what is the book value? What is the depreciation that has been done till date? And what is the net value? Right? These are the various things that happen. And along with them, we are also talking about any assets. Are they pledged as collaterals for getting some additional finances or for some loan purposes? Probably some of the assets would have been kept as the collaterals with the banks and all. So those kind of details have to be mentioned. And any asset that is revalued, especially for IFRS, because revaluation model is permitted only in IFRS. So wherever the assets are revalued, we are talking of when they were last revalued, what was the mechanism, what was the basis for revaluation, because probably they may say, oh, the land which was worth 50,000 when I purchased it, today I may say it is worth 2 lakhs. No base to it. So they have to clearly mention what is the base behind it, right? Who has actually revalued it, on what basis it was revalued, and if it was valued using the historical model, which means no revaluation model, what would have been the carrying value of that? The same land, as per gap, there is no revaluation. So the same 50,000 has to be shown for land every year. Whereas because of IFRS, I may show it as 2 lakhs. So what it says is show both of them. Though in the main statement you show 2 lakhs because you are following a revaluation model, but you show that the book value of it is only 50,000 if the revaluation model was not used. Because the analyst will typically convert it, because if one company is not following a revaluation model, the other is following a revaluation model, comparison wise he should be able to compare both the companies comfortably, right? From that standpoint, this is what is being brought up. And finally, whenever we are this is one new thing that has come out with respect to IFRS. Again, property like building or land, right? If they are purchased not for the purpose of business, but for the purpose of rentals, like sometimes just like we purchase some plot in some corner of the cities just for appreciation purpose, companies also may do that. Company also, okay, they have purchased one building, but they are not using it for business, they have rented it out to someone else. So whenever company invests in real estate properties or anything just for the purpose of investment, not for the purpose of using for business, more from a rentals and capital appreciation kind of perspective, which means whenever it wants, it will sell it off also. Whereas if this is used for a factory, then even if the real estate prices go up, it cannot sell that off because it is required for the business. Whereas if the same place is given as a rent to someone, right, when the price goes up, they will sell it off. So what the IFRS started saying, this is applicable only for IFRS. What the IFRS started saying is, treat these two properties separately. The one which is used for a business purpose versus the one that is not used for the business purpose. The one that is not used for the business purpose, treat it as investment property. And any revaluation you are doing, the difference is only with respect to revaluation. Any revaluation you are doing, earlier what did we say? Any gain that comes because of revaluation, you are taking it into other comprehensive income. Whereas here it says any gain that comes in the middle, even if you have not sold off that property, any gain that comes, you can very well treat it as a gain in the income statement itself for these kind of properties, right? Any gain that you get, you can very well treat it as a gain and treat it in the income statement itself. You don't need to show it under the other comprehensive income of the balance sheet. All right.